What we'll do is we'll talk about individual stocks and sectors with our research team. There's lots to get by. Earnings season is winding down. Nigel, why don't we start with Vedanta and Hindustan Zinc?
Well, that's right. Everyone's waiting for the government of India to go ahead and sell stake via the OFS route in Hindustan Zinc. Well, Mr. Agarwal, he does something again that, yeah, he beat them to it. So, and Nimesh had mentioned this as well in D Street Chatter, that this could be a probability that takes place. So the news basically is that Vedanta is looking to sell close to 2.6% stake via the OFS route in Hindustan Zinc. To give you a shareholding pattern first, Vedanta as well as the government of India, they have 95% stake in the company, and LIC is the remainder. So basically free float is very, very limited at around 2.5%. What can Vedanta get? Well, if they sell that 11 crores at current market price, they'll get close to around 6,400 crores. But this pricing is likely to be much lower because as of now, Hindustan Zinc, because of the limited float, is trading at around 13 to 14 times, assuming the EBITDA number of around 17 to around 19,000 crores in the next two fiscals. So the pricing will be a little bit lower. So in all probability, Vedanta could probably realize close to around 5,500 crores or thereabouts. For Vedanta, it's positive. Why? They can give dividend, they can repay some debt, and they can also fund their capex. So green on Vedanta, and in fact, we've seen some shorts build up into the system as well. So I expect that stock to gap up. Phillip Capital, they have gone ahead and they have said that they're expecting a 4 to 5% up move based on this news piece. So positive on Vedanta, and Hindustan Zinc, well, it'll correct because this deal is like to be done at a bit of a discount.
Okay, so Vedanta in focus for sure. Let's move on. The next one on our radar is going to be Hero Moto. The company declared numbers yesterday after market hours. Sonal, how did they look?
Well, these are good numbers on a YY basis, but earnings were below what the CNBC-TV18 poll suggested. EBITDA margins, they were impacted because of higher raw material costs, and realizations, they grew just 2% on a YY basis. To take you through the YY numbers, the revenues were up 16%, EBITDA grew 21%, margins were up 60 basis points, and profits were up 36% as well. However, all these numbers were lower than the poll or the street estimates. In terms of outlook, the management says they have witnessed positive trends across domestic, EV and global business, optimistic about demand trajectory in coming quarters, and now focus will be to build their premium segment on the back of new launches in the past quarters. With inflationary pressures easing, consumer spending power is set to rise according to the management. But remember, the stock is already rallied ahead of numbers, so we could see some red today.
All right. Thank you very much, Sonal, for that. That's Hero Moto in focus. Max Financial also reported numbers. Yash is here with details. Yash, morning.
Morning, Prashant. So I'm going with red on Max Financial Services because on one hand, when the top line performance of the company in the first quarter came bang in line with what we were anticipating in terms of estimates, but there was a sharp gap which came on value of new business as well as the margins. So as far as new business premium is concerned, that came in at about 2,075 crore rupees, as I said, in line with what we were anticipating. Total APE came in at about 1,453 crore rupees. Retail APE came at about 1,260 crore rupees, but the gap that I'm talking about, value of new business, that came in at about 254 crore rupees. What we were anticipating was about 285 crore rupees. The gap just widened further when it comes to margins. The margins came in at about 17.48% versus estimates of about 21.46%, which means a near 400 basis points gap when it comes to margin. That's going to be, trouble for the company. Of course, the margins miss has come largely because of a strong growth as far as the ULIP business for the company is concerned. Largely, the new business premium on a year-on-year basis was up 12%, total APE growing at 31%, retail APE growing at 27%, and margins on a year-on-year comparison came down by about 472 basis points at 17.48% versus 22.2%.
Okay, all right, got that. Thanks very much, Yash, for Max Financial. Let's look at the other important number that came in after market hours, and that is Apollo Hospitals. We have Ekta breaking it up for us. Ekta, how are the numbers?
Thanks for that. Well, Apollo Hospitals was an inline set of numbers. The street was anticipating a 15% revenue growth. That's what they reported. They reported a 15% revenue growth. Margins in line with estimates of around 13.3%, and a profit which was better than estimates at over 300 odd crores. Now, the hospital revenue, which is their bread and butter, was up 15%, but the average revenue per occupied bed was up only 2% year on year. Compare this to around a 12% growth that they reported in the previous quarter. Diagnostics, the margins improved to 9% versus 7%. Apollo Health Co, which houses Apollo 24/7, the EBITDA was 22.5 crores versus a loss of 56 crores year on year. And the Apollo 24/7 Q1 GMV was up around 9% year on year. So overall, all the statistics look good and largely in line with Apollo, with the estimates. But I would just watch out for commentary with regards to the average revenue per occupied bed.
Okay, in fact, we'll have the management joining on later on the show at around 9:40 a.m. to detail their Q1 numbers. But let's hop across to Vamakshi. She's here to tell us about Muthoot as well as Manappuram Finance. Morning, Vamakshi.
Well, good morning, Nigel. Let me first start off with Manappuram. Gold loan saw a very strong growth of almost 15%, and management has in fact gone ahead and raised their guidance to 15% loan growth in the gold segment for FY25. Non-gold loan AUMs too was sharply higher, almost 30%. NII came in slightly lower than what the street was expecting, and that is mainly on account of lower interest income. NII saw an uptick of 19%. PPOP, however, was higher than what analysts were expecting, and that is mainly on account of lower OPEX. Provisioning came in slightly higher than analysts' expectations at 228 crores. Net profit, however, saw an uptick of almost 12% and came in nearly 4.5% higher as compared to analyst estimates. Asset quality for the company was also largely stable. GNPA saw a small uptick of 16 basis points sequentially, and NNPA was largely flat on a sequential basis. So overall, going with a green for Manappuram. But on the other hand, going with a red for Muthoot Finance. There's no complaining about loan growth here because we're seeing a 25% uptick on a YOY basis, 11% sequentially. NII too was in line with largely what the street was expecting. NII came in at 2,305 crore. NIMs have contracted marginally both on a YOY as well as sequential basis, but it is the asset quality that is a bit of concern for Muthoot because the GNPA has deteriorated by almost 70 basis points sequentially. Provisionings have seen an uptick of almost 160% on a sequential basis, and because of higher provisioning, there's a miss on the PAT as well. PAT came in only 11% higher. So overall, going with a red for Muthoot Finance, mainly on account of concerns around asset quality.
Okay, well, you'll hear from the management of Manappuram a little later on the program. So Mr. VP Nandakumar, MD and CEO of the company, with us to take questions as to what the outlook looks like. Vamakshi, thank you very much for that. Let's move on, though, and talk about Nykaa as well, which reported earnings. Mangalam is here with that one. Mangalam, morning.
Good morning. So, it's been a weak consumer sentiment, and as a result of which the company in that has reported a decent performance. It was a tough quarter, and the net profit has jumped on a low base. So 23% growth in their revenues. The EBITDA has actually seen a 31% jump. Margins have improved by about 30 basis points, the reported ones. And the net profit has jumped all the way from 5.5 crores to about 14 odd crores itself. The beauty business, that showed a revenue growth of 23%, margins of almost 4.6%, so EBIT growth of almost 25%. Fashion showed a revenue growth of 21.5%. And out there as well, the contribution margins actually improved. So beauty GMV was 28% higher, but the company had to give a fair amount of discounts, etc., which is why revenues are around 23% higher. And fashion contribution margin, even though it's an EBIT loss-making business, they are focusing on profitability, and contribution margins have improved by 600 basis points. And the superstore business, which is their B2B business, showed a 72% jump in GMV. So put all this together, along with the fact that the stock was down 4.5% yesterday's trading session, see a bit of green on Nykaa today.
Okay, all right, got it. Thanks very much for that, Mangalam. Let's move on and look at some more names. I think we've got Vivek now joining in because we've seen earnings from GMR Airports, also SJVN. Vivek, morning. Take us through the numbers.
Well, good morning. GMR Airports, operationally decent set of numbers, but on the bottom line, there was a loss reported, and the company has explained the multiple one-offs. First up, let's have a look at how exactly the operations panned out. Revenues higher by close to 19%, a little over 2,400 crores where the revenues came in at. EBITDA, the core EBITDA was higher by 19%. Margins are staying flat on a year-on-year basis at the 37.3% mark. However, on the bottom line, the company saw a net loss of close to 340 crore. What impacted the bottom line? Number one, finance costs this time were much higher, coming in at close to 890 crore versus 576 crore on a year-on-year basis. The company says this includes payments on account of forex fluctuation in the FCCB payments towards ADP. Also, the depreciation this time around was much higher at close to 466 crore. Also, remember, the base quarter actually had a one-time gain of close to 76 crore. Apart from that, the company has also taken an enabling provision for raising close to 5,000 crore either via the QIP route or the FCCB route. The second stock is SJVN, a very strong operational quarter, higher PLFs, higher PAF, both aiding the profitability. Revenues higher by 29%, coming close to 870 crore mark. EBITDA higher by 32.5%. Margins very strong, 76.7%. Profitability on the back of that higher by 31.5%. The gross power generated by the company was up 56% on a year-on-year basis and up almost 3.7 times sequentially. Also, there was a 14% increase in installed capacity as far as the company was concerned. Remember, one board approval coming in, the company is looking for dilution of stake as far as HJV and green energy is concerned, and that will also be an important trigger to watch out for going forward.
Okay, all right, got it. Thanks very much, Vivek, for that. We'll watch out for those stocks as well. So here's a quick recap of the list this morning. Stocks that have positive news flow around them are Vedanta, Apollo Hospitals, Muthoot Finance, Nykaa and SJVN. Stocks with negative news flow around them: Hindustan Zinc, MotoCorp, Max Financial, GMR Airport and Muthoot Finance.